This is the sequel to the video I put out Friday this week entitled Commitment of Traders. Just a brief warning before you get too far into this video. This will be of a more speculative nature than that one, because rather than analyze the past, this one presents a possible outcome of how the players might play their hands going forward, and what it would mean to the futures market. I titled this video War Games because war games are how the military prepare themselves for dealing with threats. By simulating situations, it allows the military to prepare themselves mentally for things that might happen in the future and how to properly react. We should discuss what might unfold in the futures market and be mentally prepared for it. After all, the price that we see every day on our computer screens is determined not by the physical market, but by the interactions of the various participants in the futures market. Understanding the futures market, what the players might do going forward, and how it would affect the price you see on your computer screen will help you prepare yourself mentally for an uncertain future. I often hear people state that because the shorts don't have the metal to deliver, eventually there will be a short squeeze and the price of metal will skyrocket. I happen to believe that the value of the real metal will in fact skyrocket, as many propose. However, I think first we'll be presented with a very different picture on our computer screens. So let me paint for you one possible scenario, and let's have a discussion about it so that we can prepare ourselves mentally if it should come to pass. Let's start with this historical view created from the Commitment of Traders reports released by the CFTC every Friday. If this is the first time you've seen this graph presented, I suggest you go back and watch my video entitled Commitment of Traders. Let's review who the players are and how they interact. The red curve on the top represents the suppliers of metal. These are the mines, refiners, and others who supply metal to the market. They need to hedge the metal price because in the time that takes between when they borrow money to fund their operations and when they deliver the metal, if the price drops, they get crushed. This group also includes the bullion banks, who are involved in the business of gold and silver loans. The blue curve on top are the speculative longs. This group of players are betting on price increases. They are not so much interested in obtaining the metal, so much as in the making of a paper profit should the price of the metal go up. This group is providing the price insurance that the commercial shorts need in order to hedge their risk of supplying the metal to the market in the future. On the bottom, we have the blue curve representing the commercial longs. This group is interested in obtaining metal in the future. They would like to lock in a price now for metal that will be delivered to them in the future. This group consists mainly of fabricators and investors. The red curve on the bottom are the speculative shorts. Just like the spec longs, this group is interested in a paper profit should the price of silver decline. They are providing insurance for the commercial long group. Let's take a look at fabrication demand as compiled by the Silver Institute. According to the data, fabrication demand, which includes industrial use, jewelry, photography, silverware, and the manufacture of coins and medallions, has not been on an upward trend. Yes, the data fluctuates, but the total annual fabrication demand is no higher now than it was 10 years ago. The silver needed to supply the fabricators has averaged 875 million ounces per year. This is the silver supply that the fabricators need to hedge with futures contracts. So with that in mind, let's go back and take a look at the commercial long category and the speculative short category. Here is the data we need to look at from the standpoint of hedged demand. We can see that about 10 years ago, the commercial longs held at any time about 100 million ounces worth of futures contracts at any given time. There wasn't a great deal of investment interest in silver in 2004. Coin and medallion demand was only about 5% of total fabrication demand, so the 100 million ounce futures position at any time was probably the amount of long futures contracts that the fabricators needed. So let's put a line on the chart that will represent the futures needed to satisfy the needs of the fabricators. You're probably asking yourself, why only 100 million ounces of futures are needed to hedge 875 million ounces worth of demand? Well, remember, the fabrication demand does not need to be hedged for multiple years. The fabricators will put in an order which will normally be satisfied within a month or two. So the contracts used for hedging the supply will turn over fairly quickly. The important thing to realize is that because fabrication demand has not increased, there's really no reason that more contracts would be required to hedge supply now than were required 10 years ago. So, if fabrication demand for silver has been flat for 10 years, what explains the dramatic increase in the commercial long position over the past decade? Well, recall from my Commitment of Traders video that the bullion banks are considered part of the commercial category and not the speculative category. This is because they are involved in making gold and silver loans to the miners, providing vault services to large investors, and providing a means for large private investors to obtain large quantities of metal. The 4 to 5-fold increase in the commercial long contracts is not the fabricators, but the bullion banks. This increase represents investment demand. Whether it's the bullion banks acting on their own behalf or on the behalf of other investors is not important. What is important is that because it is in the commercial category, these contracts represent the interests of people who want real metal, not paper. So why is all of this important? Let's look at an aggregate picture of the commercial group and the speculative group. Over the past 10 years, the commercial group net short position has gradually been coming off. The reason for this is increased investment demand, as we've discussed. As it stands now, the commercial long positions are roughly equal to the commercial short positions. Is there a reason at this point for the commercial group to become net long? I don't personally think there is. Remember, the speculators don't have metal. They only act as an intermediary and as providers of insurance. If the commercial longs want metal, they are going to have to get it from the They are not going to get it from the speculators. They're going to need to get it from the commercial longs, in other words, the producers, with the speculators acting as intermediaries. Silver mines are not going to put on more shorts than the metal that they think that they can supply to the market. So the investors on the long side must realize that they've got the market on the future production cornered, and there's no reason to believe that they'll be able to realize a greater share of future supply than they have locked in right now. Okay, so with all that information presented, here's my proposed scenario. Basically, I believe that the future supply of silver and gold is more or less cornered. We know that right now mines are in a very distressed position due to the current low price of the metals, and I believe that a few major mines will probably go bankrupt as a result. So as a result of this, short positions on the futures market will be cash settled or defaulted upon. And as a result, the commercial longs will see this happening and lose confidence in the futures market. They'll come to the conclusion that they won't be able to use future longs as a means of obtaining real metal anymore. So they'll all of a sudden withdraw all of that support. So at least in the silver market, it will mean the sudden taking off of about 350 million ounces worth of commercial long paper, which will cause a sudden drop in the price of paper metal, which of course would lead to more bankruptcies of mines. We would probably see a sudden surge of physical silver coming from panicky investors who were relatively new to the market and who have been stacking silver and gold, who would basically just rely on the prices on the computer screens, and they'd want to protect themselves and keep their paper profits, so they would sell into this market. Now, the big investors, not having the futures market available to them anymore as a means for picking up real metal, would probably try to pick up as much of this gold and silver as possible. They would go to the retailers and they would bid up the price. Now, the retailers, because they'd be involved in these private deals, would be knowledgeable about how high the price of physical metal was going in the private market. And they would take advantage of this. They'd take advantage of it by offering to sell metal at sky-high prices to big investors who wanted to obtain it. But they would still offer the low, publicly disclosed futures price to the investors who wanted to sell. And this would probably take place for a period of time that was long enough to exhaust the supply of physical market, going from the small investors to the big players who were more knowledgeable. So for a period of time, price discovery on the futures market would basically be useless because it would be completely misleading. But at a later point, price discovery would start to happen on the physical market, and we would start to see prices which are much, much higher than they are now. But unfortunately, it would mean that all the small players would now no longer have their metal, and the big players would have basically the metal that they wanted. So anyway, that's my proposed scenario. It's something that I think that we ought to prepare mentally for, because it is a real possibility. There are others, and maybe we can think through some of those together. I'd be very interested in your comments on this video. Let's discuss it, and let's prepare.